Housing affordability is a pressing issue that seems impervious to easy solutions. Policymakers, economists, and frustrated renters alike often look to monetary policy for relief, hoping that changes in interest rates might somehow tame housing costs. Yet, despite dramatic shifts in monetary policy over recent years, whether through historically low interest rates or aggressive rate hikes, the housing crisis has persisted, leaving millions priced out of home ownership. At its heart, the issue goes deeper than money. It's a problem of supply and demand tangled in a web of regulations, market dynamics, and human behavior. For most of us, a house is far more than an asset. It is a home, a place where we lay down roots, build memories, and create a sense of belonging. For economists, however, housing has another identity. It is an investment. Whether through rental income or the consumption of housing services by owner occupiers, housing generates returns. Much like any other asset, in the world of statistics, this duality is captured by owner equivalent rent, OER, which accounts for about a quarter of America's inflation measure. Housing is central to both our personal lives and the broader economy, but its unique nature makes it a challenging market to influence directly. Traditionally, the relationship between interest rates and housing prices has been straightforward. Lower interest rates reduce borrowing costs, making mortgages more affordable and pushing up demand for homes, which in turn drives up prices. Similarly, higher rates should dampen demand and reduce prices. But in the real world, this theory doesn't always play out as expected. After interest rates began rising in the 2020s, housing prices barely budged. Why? The answer lies in the rigidity of housing supply. In an ideal world, higher home prices would encourage developers to build more homes, balancing supply and demand. Historically, this was the case. In the 1970s, a 1% increase in home prices typically spurred a 6% rise in new construction. But by the 2000s, that response had fallen to just 4%. Over the years, stricter land use regulations, NIMBY, not in my backyard, activism, and declining construction productivity have throttled the housing supply. Even when demand surges, developers struggle to keep up, leaving potential buyers with fewer options and higher prices. This disconnect between supply and demand fundamentally changes how monetary policy impacts the housing market. While most asset prices adjust quickly to changes in interest rates, housing operates on a much slower timeline. Buying or selling a home can take months, if not years, and new construction faces even longer delays. When supply is unresponsive, lower interest rates don't lead to a flurry of new homes being built. Instead, existing properties become more expensive, exacerbating affordability issues. Moreover, the effects of monetary policy ripple unevenly across the housing market. For example, in areas where developers can respond relatively quickly to price changes, housing prices stabilize after an initial bump. But in regions where construction is sluggish, prices simply keep climbing. This creates a self-reinforcing cycle. As house prices rise, potential buyers begin to expect further increases, driving demand even higher. Homeowners benefit from this dynamic, seeing their properties appreciate in value, while renters and aspiring buyers are left further behind. For renters, the situation is particularly grim. Many hope that rising interest rates might cool housing prices and open the door to home ownership. But the reality is more complicated. As borrowing costs increase, owning a home becomes less affordable for many, forcing more people into the rental market. This additional demand drives up rents, which further squeezes renters' budgets. Landlords, meanwhile, often seek higher returns to offset the rising cost of alternative investments, exacerbating the problem. In theory, rising home prices should encourage landlords to sell to wannabe homeowners, creating more opportunities for first time buyers. But research shows that the rental and ownership markets are surprisingly segmented. Instead of helping renters transition into home ownership, higher rates often leave them stuck paying ever increasing rents. This segmentation helps explain why housing affordability has remained so elusive, even as central banks around the world have experimented with both loose and tight monetary policies. The impact of these dynamics goes beyond individual households. Shelter inflation, the rising cost of housing captured in inflation statistics, has been one of the most stubborn components of broader economic inflation. For central banks like the Federal Reserve, which are tasked with keeping inflation under control, this poses a significant challenge. Even as other sectors of the economy stabilize, housing costs continue to rise, complicating efforts to bring inflation back to target levels. The current state of the housing market reflects a perfect storm of constraints: tight land use regulations, inefficient construction practices, and a monetary policy that influences demand without addressing the underlying supply shortage. The result is a market where neither cheap money nor expensive credit can solve the problem of affordability. For many young renters and aspiring homeowners, the dream of owning a home remains just that, a dream. So, what can be done? The answer lies not in monetary policy, but in systemic reforms to the housing market. Increasing the supply of homes requires bold action, loosening restrictive zoning laws, investing in construction innovation, and streamlining approval processes for new developments. Without such changes, the housing crisis will persist, leaving both renters and buyers trapped in a cycle of rising costs and limited options. Until then, we must confront an uncomfortable truth. Monetary policy, whether hawkish or dovish, cannot make housing affordable. It is a blunt instrument for a problem that requires precision. The real solution lies in tackling the gummed up supply side of the housing market, ensuring that the dream of home ownership is within reach for future generations.